Welcome to Union Square Ventures. We're really excited to host this event. It's part of New York Tech Week. A couple things that I want people to know. We are recording this event. We are also live streaming this event. The TV in the back there is actually what's being live streamed, so if for some reason you can't get a seat and you can't see, you can kind of watch that. And we're going to do a fireside chat for about 40 minutes, and then we're going to take questions for the last 20. So if you have something that you want to ask, remember it, and hopefully you'll get a chance to ask it. I want to thank, first of all, the team at Union Square Ventures who put this event together. It was a bit of work, and I really appreciate them doing it. I want to thank my friend Mark Mullen, who convinced me to do this, and he reached out to me sometime this summer and said we should do this for New York Tech Week, and so thanks, Mark, for doing that. And I really want to thank Katie from Bloomberg, who agreed generously to spend some time this evening and facilitate the conversation. And with that, I'm going to turn it over to Katie, and we can have our conversation.
Happy to be here at New York Tech Week. So wanted to talk to you guys about the current fundraising environment. Obviously, things have changed. There have been some ebbs and flows the last few years, in case anyone didn't hear. Wanted to hear what that looks like at the early stage right now. What are you seeing?
Well, that is the big question. And we've gone through a lot of machinations over the last couple of years, of course. And so there's really two fundraising environments. One is for new companies that are looking to get financing. This is more in the seed stage or the pre-seed stage or the A stage. And then there are, of course, companies who've already been financed who are looking for more capital. And that's kind of a different discussion. What we're talking about here today, or going to focus more on today, is really the seed through A stage. Bonfire is a seed staged focused firm. We only do B2B seed. We only come in at seed, meaning no pre-revenue, no pre-product, et cetera. But we really then emphasize and work hard to help our companies get through the A, which is one of the areas that Fred is an expert at. So that's why we try to put this together to have kind of a cohesive conversation. So what are we seeing in the seed stage? We are seeing a ton of companies, but we're having a lot of companies that are having difficulty demonstrating the type of traction and progress that we want to see to do the seed stage. The second thing is, while there has been a decline in valuation, as expected and should have happened, it's not as aggressive as we think it should be. And I think that's a function of, very simply, supply and demand. There are still a lot of capital available, and there is not enough great companies. However, there are still incredible companies being built, and our job is to actually find who those people are and help them get to that next stage.
Fred, do you agree with that there's too much capital relative to the opportunity?
I actually don't think that there's ever too much capital relative to the opportunity. I think that founders that we're backing are building the products and services for the future, and there should be plentiful capital for that. So I don't like the idea that there's too much capital in the sector. But what I think happens in markets like we've been in for the last couple of years is a lot of people sit on their capital. So what Mark is saying, there's a lot of capital still in seed funds, venture funds, that's not getting deployed. And so when a deal gets competitive, it's easy for lots of people to just bid the price up, and that does happen. So I think it's a weird market where some people are finding it very difficult to get money out of VCs, and other people are saying, oh, the market's still too frothy. And I think both things are true at the same time. Seems weird, but I think they're both true at the same time.
Do you think there's a bit of a lag effect that maybe, the later stages first saw valuation correction and a lot of that's still getting sorted out at the earliest stages?
Well, what happens, if you think about it, is that the public markets correct. So all of a sudden, SaaS companies go from being worth 20 times revenues to being worth 5 times revenues. And then what happens is the people who are financing the companies for that last little bit to get into the public markets have to say, oh, I got to take my valuations down. And then the people who are financing the companies to get to the growth stage have to take their valuations down. And that whole thing takes a lot of time, as you just said. So it could take 6, 12, 18 months for that whole thing to kind of cascade all the way down. And then seed is a different thing, because in seed, you're not really, you are financing to the A round, and you want to see the company get an increase in valuation to the A round, but there's still like a limit to how much of the company a seed investor can really take, because you have to leave a lot of equity in the hands of the founders, because you know that they're going to get diluted in the A and the B and the C. You want them to continue to own a meaningful percent of the company. So sometimes the seed market is the last to really reprice.
Yeah, I would agree with that, just because of the cascading effect. But from the seed perspective, only, and I don't want to just keep talking about the past, but we're still dealing with it, particularly 20 and 21. Only 2016, 17, 18, remember that's 5 years ago, were we investing at 5, 6, 7 pre's for seed. And we were putting in $2 million for seed. That has now been taken over completely by what's called institutional pre-seed. And that's fine, as long as the valuation makes sense. So on the
Mark,
seed,
can you explain that? I'm not sure I even totally understand that. So what you just said was that in 16, 17, and 18, a seed round would generally be 5 million pre-money, a couple would come in, it'd be 7 million post-money.
be 5, 6, 7 pre's.
And then you just said something that's now called institutional seed?
Yeah.
What is that? What do you mean by that?
Institutional pre-seed. So there's been, it used to be that seed investors, we used to call it early stage. I don't want to get too in the past, but we used to call it early stage. And we would invest on top of angels and friends and family. And that was very normal. And even you would invest on angels and friends and family, even doing an A round. And then there's a stage called pre-seed, trying to get in earlier because we were finding companies we wanted to get ownership, so companies were investing earlier. And there became a segment which is now called the pre-seed round, which has been institutionally financed by
okay, so what you're
many
saying is
GPs
that the friends and family and angels are getting replaced by funds that are
Yes.
funded with institutions that are now doing pre-seed. They're doing those rounds instead.
Yes.
Okay.
And so, where we used to do $2 million rounds and own a percentage, we still are looking for our ownership, but in order to, because rounds have gotten bigger, instead of $2 million rounds, they're 5, so the price has gone up. So the founder still has the same equity. Because you're saying, we still have to leave equity for the founder going forward. So now the prices have gone up, so essentially just double it. So you come to me and you've raised 2 at 8 pre from your pre-seed, and now you have some revenue, very little revenue, and now you expect to double on that, and a bigger round, and because we were all getting rewarded for the later rounds. One of the things I would say to my team is the A is not the win. A is not the win, and we all learned that a little bit in 21.
So there's a lot of capital in the ecosystem keeping prices relatively high, but one thing that's been pretty high is AI. Are you guys excited about AI? Are you all in on AI, or are you looking at other sectors instead?
So we had an event today here at USV in our library, which is the room back in the corner. We had 70-ish people, most of them in our portfolio, demoing AI features that they have built into their products. So these are companies that we funded before ChatGPT came along, right? Who have products that have been in market for 3 or 4 years or more, and they are now, those teams inside those companies are now building AI into those products. So we had those companies demoing to each other. And what that really drove home is a comment Mark made to me, which is, we're not investing in AI, we're investing in the same kind of companies we always invested in, but those companies are increasingly using AI to make their businesses better. That's what you said, right?
Yeah, I think for us, particularly in the seed stage, in our portfolio prior to the explosion of ChatGPT, we have 8 companies where their website is, bonfire.ai. And so AI is not a new thing. We all know that, machine learning, et cetera. The uses now and the way you can use it have changed. And that then needs to enhance the solution you already have, or enhance the data you already have, as opposed to just a wrapper is what everybody's calling it.
So what about crypto? I know, Fred, you've been involved with Coinbase. You're on the board there. Obviously crypto's gone through a bit of a change the last couple of years. Are you still excited about that at the early stage?
We are, and we have 3 working groups inside of USV that meet every week. Those working groups are our AI group, our Web3 group, and our climate group. That doesn't mean those are the only things we invest in, but those are the sectors where we're the most actively out there trying to refine our thesis, source opportunities, get out ahead of the curve. We've been investing in education and financial services and healthcare and other sectors for a long time, so we really kind of know what we want to do in those sectors, but Web3, AI, and climate are the ones where we're doing the most work of really sort of doubling down. So absolutely, and think of the investments that we've made this year to date, let's say we've made 10, I think maybe 2 or 3 are Web3 investments.
And Mark, what are your favorite sectors right now?
We really focus on vertical software companies that are using SaaS and also providing transactions. So it's not just fintech, it's a SaaS solution, for example, in pharmacy payments or insurance, et cetera, where they're going deep into a vertical and generating revenue from 2 or 3 different types of revenue sources, whether it's transaction fees, credit card fees, plus SaaS.
And so what kind of qualities are you guys looking for in early stage founders? How do you know someone's going to be able to execute on their plan?
So I like to think of risk, the risk that we take as investors, in 3 buckets: team risk, product market fit risk, and TAM, total available market risk. And I think over time, those are the 3 areas that if you get wrong, you're screwed. And so the team is super, super important in our decision to make an investment. And what we're really looking for in the founder or the founding team is the ability to recruit a team, to raise capital, and to get customers, the 3 R's: raise, recruit, revenue. And the thing that causes more companies to fail than anything else are found. I think this thing is. Oh yeah, I got it. Are founders and founding teams that are not good at those 3 things. And if you think about those 3 things, they're all the same thing, really. They're selling.
Exactly. I was going to summarize it by saying SELL. And it's kind of unfair because that's a personality trait that people are strong at or not as well positioned for. And so you might be an incredible technologist or incredible engineer and you've come up with a beautiful product and you're not good at raising capital, right? Or you're not good at, you don't want to sit down with Fred. Most people do want to sit down with Fred, but you don't want to sit down with Fred. And so I try not to be unfair by saying, but you have to be able to sell, like for those 3 reasons. It's just not, hey, I can recruit a team, you go take care of the fundraising. I can do fundraising, but I don't know what I'm doing over here on operations. It's really hard to be a founder, right? The other thing that really was difficult in the past few years, in which we're really focused on and have been focused on for a long time throughout our careers, is spending time and getting to know the founders. It's kind of unfair to you to say, hey, nice to meet you on a Zoom, and we think you're good, or we don't think you're good enough. And that was really what was happening for a few years there in terms of being driven by COVID, but also the timing and the capital that was coming into companies. There was very little time to spend the time with founders and convince them and convince ourselves that we should be partners, because that's really what it is. You've heard this before, but it's so true. I mean, I know you have companies in your portfolio that, like 20 years, Bolster, what's his name from Bolster, Matt from Bolster. I mean, we just made an investment in June where I've known the founder for 25 years. Okay, so
that de-risks one of the 3 risks, right? You think
Yes.
about that. Why is it so easy for us to invest in serial founders? Because it de-risks one of the 3 risks. This is a founder who has demonstrated that they can do these things. So then it's product market fit and TAM. But the reality is, I think if you look at the universe of founders that we funded at USV over the 20 years or even the last 2 years, I think still at least half of the founders we're backing are first-time founders. It's just a lot more of them.
Yeah, that's what I wanted to say. So most of the companies we invest in are first-time founders. So, okay, you eliminate that risk when we know somebody, but we do need to spend time to convince you that you want to be partners with us, and we want to be partners with you because we're going to be together for a long time. And sometimes companies fail fast. Very few times companies succeed fast. So it's just going to take time. And it's a process, right? It's a process for both sides. And we like to put that out there, and we want to do as much due diligence as we can possibly do, and for you to do on us before we do it. It just takes time.
We had a conversation internally here yesterday about this topic, and we were talking about whether we can help founders become better fundraisers. And the answer is absolutely we can do that. And we do that, and we're doing more and more of that. But the comment that I made in that conversation is, but there are some founders who walk in the door and they're fucking great at it. And we don't have to teach them how to raise money. And you can win a lot with those kinds of founders.
What kind of pedigree should a founder have, especially if they're young, like 25 or even 20? I mean, what should they have accomplished in their life thus far that would impress you?
Well, that's, I don't want to go down this path of like people go, oh, you got to have grit, and like how do you determine grit it is something you can delve into. I often spend a lot of time trying to understand the person's drive and where that came from. It could come from someone's sister or brother or mother or father. It's like something that's there that's driven them to where they are. But there's so many different founder archetypes that have been successful in the past. You try not to pigeonhole anybody into one, like, oh, you have to have an engineering degree from a certain school. We're not focused on school. We're focused on the people and what they built and what the idea is. And so I'll give you an example. I recently turned down a deal with, that had three what were really, really impressive founders. They went to school together. But the reason we kind of passed is because they spent 3 months iterating in their apartment trying to figure out what business to start.
Yeah, it's a problem.
And so, that's a problem, right? Because they didn't have pain. They didn't have something that they really had to fix to make it a company. And that's what we also look for.
I back a lot of first-time founders and a lot of young founders. And, what it is the thing that Mark was hinting at is sometimes people just get to an idea, and it's just the right idea. I mean, I remember when Rob Kalin started Etsy, Rob was, 25 at the time or something, and he was freelancing, and this woman who owned a craft magazine, said to him, Rob, I want you to build a website for my magazine. And he said, great, I'll do that. And so he's building the website for the magazine. He said to her, you should let people sell crafts on your website. And she's like, oh, no, I don't want to do that. And so he's like, well, damn, I'm going to do that. And, that was a great, it was like, he just saw it. It's like, man, there's this huge white space to build a website for people who want to sell crafts, and Etsy's $15 billion in GMV now, right? So, it's just like the right idea at the right time, and somebody just has like the ability to do it. With younger founders, they've typically built something. I think it's tough for a young founder to come in and say, I'm going to build a company and get money. But if they built something and you look at it and say, oh, that's good, then it's pretty easy to back a young founder.
Since we only do B2B, what we find mostly is that the really good B2B founders are ones who started a consumer startup and learned how hard it is.
So Fred, you've been a long-time leader in the New York tech ecosystem, and recently it seems like New York tech has gained a lot of momentum. I looked at the data, and it looks like it's almost head-to-head with the Bay Area now in recent VC funding. So are you seeing this momentum, and what do you think it means long-term?
Yes, we are seeing it. I think for a long time, founders felt like they had to be in Silicon Valley to be able to raise money. And then that stopped being the case maybe 10 or 15 years ago. They knew that they could start a company in New York or somewhere else, but they still, I think, had a sense that maybe it was better to be in Silicon Valley. And I think the thing that finally sort of put the complete end to that is this idea that I can build a company that's a little bit more hybrid or remote. And so I, founder, can actually be where I want to be and start the company where I want to live. And I'm a New Yorker, so I'm going to say something that's a little obnoxious, but who wouldn't want to live here? It's the best place in the world. So, I think that's what's really happening is people are opting into starting the company in the place that they want to be in and not feeling compelled to start the company somewhere else because of external reasons.
I know it's New York Tech Week, but both Mark and I live in LA. So Mark, what are you so Mark, what are you seeing in LA?
Well, I used to live here. My daughter goes to NYU.
And didn't she say?
I used to live here also.
Didn't she say that she's going to stay here?
Yeah, I don't know if she's going back to LA for. That's what every 20-year-old says. But I love New York and I love LA. I mean, I actually started our fund in LA specifically so I didn't have to compete against Fred and some other people in Silicon Valley. No, you know what I mean. But really because we get involved with our founders and we want to spend as much time as we can with them. And I saw a burgeoning market, as other people have as well, in Los Angeles. And the first we did 46 investments in our first two funds, and 43 were in LA. And we benefited from that because we grew up as LA started growing up, just as these other cities like Seattle and Chicago and other places. But LA has now become a clear third behind New York and San Francisco. So I think COVID accelerated that, showing that there's talent everywhere. Not just in those three cities, talent everywhere around the world. But we really first focus on Southern California, but secondly in several markets, and particularly New York is one of our markets.
I mean, LA should follow a very similar trajectory to New York, because I think, as some people know, I spend a fair bit of time in LA during the winter, and LA is also a fabulous place to live. And I think that a lot of people will choose to want to start their company in LA for the exact same reason that people want to start. So people are going to start companies in a place they want to be, and they're not going to feel compelled to do some unnatural act, some personally unnatural act, to move somewhere where they think they'll have a better chance of success doing it, i.e. Silicon Valley.
I think that's one of the positives that's come out of COVID as well, which is allowing you to think you can build where you want to build. So that's a positive.
And there's this whole thing now about, like, do I build my company in person or hybrid or remote? And we are seeing all three models. And I'm not of the view that you have to have everybody in an office all the time. And because we have at least 4 or 5 companies in our portfolio that we funded in the last year or two that are fully remote. Like, no team members are working with each other at all. And they're doing really, really well. We also have some founders who are saying, I absolutely want my entire team to be in the same space. We're going to build it old school, traditional, and they're working too. And then there's the hybrid model. And so I think you can do it any way. Each way has its pros and cons, and you have to run your companies differently, but you can do it any way you want.
It's funny how the tide has turned, because maybe back in 2011, 12, 13, Santa Monica was the place to be. Like, it was cool, and all the companies I invested in had offices in Santa Monica. And what I wasn't really paying attention to was Santa Monica is the most expensive real estate in the city. And so it was kind of cool to walk and see, and that's not like New York where you can walk and see your companies, but I could walk to board meetings and other things. That was great. Or I'd catch a bird back in the day with bird something. And now, and so we used to have an office, and I'm an investment banker, so I'm an old sales guy, and I would never, ever have anybody come to my office, because I was going to come to your company and meet you in your place of work and show you respect as to what you were building. And so I never let anybody come to my office. Well, then I started going, well, why do you have an office in Santa Monica? You're 7 employees, you're paying $20,000 a month. That doesn't make any sense. And then COVID, of course, shut all that down. And now we still have an office, and nobody has offices. So if you're a 5 to 7 to 15 person office company that's building and looking at seed or early stage capital, 9 out of 10 have no office space at all. And so it's completely changed from that perspective. And so we have people in our office now, and they love to come to our office to get out of their house, right?
So VC firms are the new WeWorks, but
You know, can I interrupt? When we built this office, we talked a lot about what we wanted it to be, and I said I wanted it to be Soho House in the front, and I wanted it to be WeWork in the back, and I wanted it to be USV in the middle, and that's basically, you know, the design. And so we, in that back in that library, I would say many days we'll have a remote first company coming together for a day or a week in that back room. And so you're right, VC firms are taking that on.
so what does it take to get from seed stage to Series A? What kind of traction should a company have to get there, a startup have?
Well, since we are Series A investors, what we want to see is product market fit. And we don't do a ton of what Mark does, which is the classic sort of B2B SaaS kind of model. We do some of that, but I don't think that's really our long suit. So what we want to see is product market fit. We want to know that the team has shipped something that is resonating in the market. If it's SaaS with customers, if it's a consumer thing with consumers, if it's a developer thing with developers. We don't need to see revenue. I think that's a risk that we're willing to take, but we do want to see that they've shipped the product and that people are using it and like it.
There's no different for us. So we do like to see traction only so we can talk to customers so we can hear them say they love it. It's very simple. Like we won't waste time on your customers. We won't waste your time talking to your customers until we're very serious about making the investment. We would never take away that trust you have with your customer and talk to them and then not do the deal. I think other people.
But that is a risk, right? Because you could hear something from a customer that would cause you not to do the deal.
And we have on occasion. You know, you're like, oh, because you ask a customer, I'm just telling you since you want to make sure if you ever give us a customer to reference. You talk to them and they're like, oh, how did you connect? Oh, we connected here, and then we started using the service, and they were really good at helping us. We were kind of an early customer, so we're helping them develop the solution, et cetera. And then our last question, just so you know, is what if we took away the service tomorrow? And their answer's got to be, oh, we'd die. Something like that, right? Not that. Maybe that's not the right word. You know, oh, that would suck. You know, that would be terrible. But if you get the, you know, I don't know, just figure something out. That's not a good thing. So we really have to try to find validation. We feel more comfortable finding validation with paying customers. That's just our own comfort level. Fred's been pretty successful, so we won't challenge his style. But
you know, we did an investment recently. I won't say what the name is because I don't want to reveal anything too confidential. But we saw them running the table on a market. We saw that they lined up this company and then this company and then this company and then this company, and I went to, you know, some of my colleagues and I said, they're getting every customer, and we just that's 10 minutes for this conversation, and then we go to Q&A, right? Yeah. So I was like, we got to make an investment in this company. Like, you can sometimes see it, you can feel it when somebody's just winning, and that's what we want to invest in.
How's that company doing?
They're crushing it.
So what are some of the biggest mistakes you've seen startups made, or the most common mistakes at the early stages?
I think trying to do too much too soon. You know, I think it's very important to just do one thing and nail it. My partner Albert has this great line that I love where he says that doing a startup is like playing a video game. You just need to know what level you're on and what is the one thing you need to do to get to the next level. And then you need to recognize when you got to the next level, and then you got to figure out the next thing you got to do. But it's like, be very maniacal focused. I need to do this one thing and I need to do it better than anybody else, and then do the next thing. But if you're trying to do 3 things or 4 things at the same time, you're building a product that's too ambitious, or you're trying to serve both a consumer and a B2B market, or I'm doing AI and Web3 in my product. Like, these are not good ideas, I don't think. You shouldn't do that.
It's also very hard to have both top, meaning large ACV customers, and small ACV customers, and trying to market and sell to both sides. But to your point, it's back to the earlier point, which is it's all about customer love. So you've got to do something very well so that that customer loves the solution or loves the service, so that we can get that comfort.
How do you recommend they go about approaching their first hires? I know that sometimes can be the more difficult part when you're a tiny, unproven business convincing top talent to join you.
Well, I think the initial team, generally speaking, is best if it's a team of people that have worked together before and have built a product and shipped a product before. That's amazing, and it doesn't have to be very big. It can be 3 or 4 people, but that's the great first team. But then when you go to like the next 15 or 20 people, it's actually, I think, a bad idea to keep hiring people you know. I think at some point you have to actually start looking out and start to hire people that fit the particular role you need. So if all of a sudden you need somebody who's like a growth hacker or a growth marketer, and you don't have somebody on your team that's doing that, it might be better to go find somebody who's doing that at a company that's been really successful that you can bring into your company. So I think start with a tight-knit group of people who have already proven they can do something well together. But then as you scale, at some point you really have to start bringing new talent into the team.
To bring a couple ideas in, so we won't invest in a company that doesn't have a technical co-founder or the founder. So meaning you could be a fantastic salesperson or a fantastic product person, yet you farm out or you have a third party do the tech. We won't invest in that. We don't feel comfortable. We have not had a good success rate investing in that type. So that's one thing.
We're there too. You got to build your own tech.
And the other thing is, there are fantastic product people who we've either learned on by themselves, or they have incredible creativity, or they were at other companies where they're successful, and they have an idea. And they think that idea is going to be great. And what they do is they go and then they find a partner, or they find some sort of tech, they start to create an MVP, but they haven't talked to a customer yet. There's a lot of great product people who have great products in their heads without actually ever talking to a customer to see if the customer wants it. And it's just another point to you all that if you are building that, make sure your customer loves what you're building, back to that point. And then, as Fred was saying, when you start to hire outside, you again need to put your sales cap on. These people are going to leave their other companies or come to work for you, not make a lot of money because there's not a lot of money to go around. It's more about the equity at the beginning, and really commit their lives to this company. You've got to be able to sell that vision, and that's again part of the whole selling strength that the founder needs.
What's the optimal time to come out of stealth? I know on the one hand, you want to put the word out there so you can attract talent, but on the other hand, you might not want to tell competition or potential competition what you're doing if you want a first mover advantage that lasts a while. I mean, what's your advice on that?
I think it really depends on what kind of business you have and what the defensibility is in that business. I'm generally a fan of building your company out in the open. I think there's a lot that benefits from telling people what you're doing and putting product out there, shipping it, and having the world see it, and doing all that in the public eye. And I think you get a lot coming back at you in terms of talent that wants to work with you, customers who want to use your product. Doing something quietly in stealth, I think, is very hard to be successful. And the only times I've seen it work is if you're building something that has some real sort of unique IP that people would copy if they saw it. I generally don't like to invest in those kinds of businesses, though, because it's like, if you have to keep it private, it doesn't feel like you really have something that you can defend. What do you think, Mark?
I mean, execution is really the win. Technology is very important. I get there's still people creating patents and some unique technology, but at the end of the day, it's going to be execution more than the tech. And so if you're hiding because you think your tech is more special than anybody else, that's going to be hard to prove.
The line I really like is, your competitors can copy what you've done. They can't copy what you're going to do.
Yeah, that's good.
And just because I cover M&A and IPOs, I'm curious if you guys have any thoughts on the exit environment right now. If you're seeing, maybe strategics interested in buying startups, or what you're noticing there.
I don't think it's a great time to sell a company, and I don't think there's much of an IPO market. So I think it's one of those moments in venture capital where we're taking lots of money from our limited partners and we're not sending much back.
What do you think about that? Not returning money to your LPs? How do they feel about that?
That's exactly right. I mean, we know the 3 IPOs that just occurred. 2 of them are below the price. That may be due to a lot of different factors. It doesn't mean the IPO market's opened up. It's going to take a while. It's going to be back to founders and companies that are private, and big private companies proving they can get to profitability. That's what's going to make the difference. It's no longer a revenue game, multiple of revenue. And so we need to see that. The M&A front's the exact same. There's been some big M&A transactions that we've seen. Actually, the biggest software M&A transaction ever was Cisco recently, but that doesn't mean the market's open. What's interesting as well is back in the 3, 4, 5 years ago, you could do an acqui-hire if the company wasn't working out and just get that done really quickly. Very rare to see those now. The small M&A market is not open either.
What's really interesting about M&A, and Mark, you spent 20 years of your life doing M&A, so I don't know why I'm saying this, but what I've observed is that companies typically are most active when they feel like it's a little bit like FOMO, like they need to transact, right? And in a market that's, down and everybody's sort of been cutting and getting their business economics, their fundamentals underway, and it just doesn't seem like a time where companies are feeling like they're going to miss out on something. So they're not as aggressively trying to buy companies. There are places where that's not the case. AI is a great example of that. You mentioned that AI is a hot sector. It is. And we sold a company, we didn't sell it, but a founder in our portfolio sold his company to Thomson Reuters this year, which was a legal software company called Casetext, which had spent the last 3 years building on top of OpenAI and was about 2 or 3 years ahead of the legal software competition in building AI-powered software. And Thomson Reuters just had to have it, and so we got a nice exit in the middle of a pretty bleak time. So you're going to have some moments like that, but generally speaking, I think it's not a great time to get out of our investments.
Yeah, we sold Scopely in July for $5 billion.
To Saudi Arabia.
But I find that to be a miracle that happened. So it's not a frothy market, and I believe that we also have an regulatory environment that is not positive to M&A. Right.
Yeah, well, yes, but the courts have basically slapped the regulators around a fair bit. So
we'll see how it plays out. But it feels like, I guess Microsoft getting that deal done for EA is a big deal.
Well, when Thomson Reuters made the offer to buy Casetext, the lawyers were like, "Oh, this is going to get something happens in a second letter, there's a second something like the Justice Department." Takes a second review or something of certain companies. They're like, this company's going to get a second review. It's going to take you a year to close the deal. It didn't happen. So I don't know. I think we're more scared of the regulators than we need to be in all sectors. We're more scared of the regulators we need to be in M&A. We're more scared of the regulators than we need to be in crypto. We're more scared of the regulators we need to be in healthcare. We in the venture capital business are too scared of regulators.
And on that note, I think we'll go to the Q&A.
Let me add one more thing.
Okay.
If there's something you could do for yourself, or should have done for yourselves, was to read Fred's blog for the last 15 years, which he no longer writes because he's getting lazy. No, I'm joking.
I went from writing every day to writing every week to writing a couple times a month.
You can see he's a contrarian, and that has seemed to work very well. And had you followed his blog the last 15 years and just bet on his blog, you would have done very well. So I like what you're saying over here.
All right, well, thank you. Appreciate it. And then,
Yeah, we can have.
Yeah, sure.
Questions?
Does anybody know what's going on over here? Did you tell them?
We're going to tell them at the end.
Okay.
Yeah, hi. Sorry. Can you hear me?
Yeah, we can hear you.
Okay. So, Ajay with Varo. And so, my company, 95% of world's video content is not searchable today. So we make it searchable and useful for shoppers and e-commerce.
What do you make searchable?
Videos.
Video.
Video content. My question is, how do you perceive competitors becoming your customers? And how do you perceive competitors investing as strategics in your company?
I don't like the latter. I don't think you should do that. That's letting the fox into the hen house. I would not do that. I love the idea of turning a competitor into a customer. That's amazing. Like, do that all day long.
Is that because they need what you have in terms of technology or
Yeah, it's the
content?
Thomson example that
Okay.
you just gave. They have a big hole in their product. What they do is a big company, and we're that missing puzzle, the piece
Yeah.
of the puzzle.
Corporate VC, CVC, an early stage, we could show historical, it has worked, but very rarely. Because it makes you feel great. You're like, oh my God, these guys really want to use us.
Right.
And so they're going to invest in us. And so you get a little bit of ego boost there and you feel like you're validated the technology and the solution and it just doesn't work that way.
My feeling is you either sell your company to them, cash out, go to the beach for a couple of years and start another company, or sell them your technology as a customer. Don't let them be an equity investor. That's just asking for trouble.
Thank you.
Hi, Fable here, founder of LH Loving Life. We're a media and education platform to empower people to live their best lives. My question is for Mark and Fred. Throughout your investment career, what was the biggest regret? Whether it's the deal that you had a chance to get in, but you didn't, and you wish you had invested, or a deal that you are 200% that the team is gonna be a big win, but it turned out to be the biggest disappointment? And what was the biggest learning, if you had any?
My regrets are always the opportunity cost
Missing
mistakes.
a deal.
I never really regret making an investment that goes south. That just comes with the territory. What I really regret is a founder coming in here, knowing we should back that founder, talking ourselves out of it, and then the founder goes on and builds a huge company, and that's just like bad. I don't like that.
Yeah, I mean, you could say the one you sold to early or the one you didn't get into. And I think the one you sold to early, you don't know it till it's later and it's past tense. So the one you didn't get into is the one that really gets you mad. Especially when you know you could have just said yes. I said no twice to Honey. And then on the email after they sold, the day they sold, I sent them an email, so I was just joking. I sent them an email. I sent them an email on the email where I passed. So it was still the same email. And I said, guys, I was just joking. Because I maintained a relationship with them. And you know, those are things that happen. Sorry. She's got it right now.
You know what we should do? We should maybe give them 2 mics and we keep one up here.
She's got one.
Okay, good.
Over here's next. The hat on is next, but you first. Oh, sorry. You're after her. After that.
My question is, you're talking to all these startups now that are clearly maybe had a product prior and they were building, but now they're talking about they have to get into AI. Do you think AI is taking the focus away from some of these startups and the problems that they're actually solving because they feel like they have to get into AI because everybody's getting into AI, instead of focusing on the problem that they're trying to solve? Yes, AI is a great layer, but is it taking away the focus, especially in earlier stage companies?
Well, I think some companies are doing that, right? Some companies are going to use it to their benefit, and some are going to use it to their disadvantage by focusing on it and trying to find something that works. And if they're trying to find something with AI that works, that means what they actually started to build didn't work. And that's hard. right? To just use it and say, oh, I got an idea.
I want to reject the idea that you have to be doing something in AI to raise money. That's absolutely not the case. If I think of the 7 or 10 investments that we made this year in new companies, I think maybe half of them are using AI. Half of them aren't anywhere near AI. So it's not a requirement. I think the question that you all should be asking yourselves as founders is, are there things I can do with these new AI tools that are available that make my product better, that make the experience better for the customer and make my products stickier and, customers can't live without them? If the answer is yes to that, then absolutely use AI. But if you feel like you need to use AI to get money, I think that's not right. You shouldn't be thinking that.
He was next in the hat, sorry.
Hi, I'm Rumi, the founder of Madeline & Co. I'm building a product that's disrupting my own industry. I'm an agency owner, and we built a product that will help strategists do what they do with the help of AI in a much faster and more efficient way. But that's not what my question is about. You mentioned that you don't necessarily invest in founders that don't come from a technical background. But you didn't go deep. I'm just asking for a friend.
Well, you have to, what I mean is, you need to find a partner, right? That doesn't mean you need to give 50% of equity to your partner, but you need to find some sort of working relationship, co-founder type relationship, or first VPN or something where that person is dedicated to your company and they're helping you build the tech, if that makes sense. As opposed to, I get that as someone who's creative in what your business was and you want to disrupt that, and technology or engineering or coding is not your first thing, that you might want to hire somebody to help you build an MVP or to start to understand how the technology is going to help. But you do need to have in my opinion, this is how we invest, I'm not talking for other people, you do need to have that person committed to being in your company and part of building that technology going forward, if that makes sense.
It does. Can I have a follow-up question?
Sure.
So I had no idea what Python was as of 10 months ago, what APIs are.
So you're on a journey.
But I have read more scientific papers about AI and prompt engineering or LLMs more than anything else in my life. I can now read and critique code. There are softwares that are helping me to critique the code that my developers are writing, and I'm learning every day. So, and with AI helping developers do what they do at a much faster pace, or a lot of people learning how to use AI to write code, is it climate changing? Is the attitude changing towards being
Not fast enough for your benefit. 5 or 10 years from now, maybe, but I think for now the venture industry is pretty much going to have trouble backing a leadership team of a startup that doesn't have a strong technologist on it. And that's just because we've had very bad experience. Not just Bonfire, USV and many others have had bad experience backing teams that don't have a technologist on the team. And so I think for at least the next few years, that's going to continue to be the case.
all right, thanks.
Samara? Samara.
Hi, Samara with Chingona Ventures. My question is, you've invested in multiple different market cycles, and we're in a cycle right now where we're starting to see some interesting deal terms. And so, being bad for the founder, I think the last 2 years were very founder friendly. So how do you think about, or what are you seeing in terms of deal terms that investors are trying to get a good deal out of a company? How are you thinking about it? And then what would you advise founders to look out for to understand what's non-standard?
Well, so that's a great question, by the way. Thank you for asking it. What happens in the venture industry and the startup sector is you have periods where the deals are too good to be believed, and the money comes at almost any price. And then there's often, I always say the pendulum swings too far this way, and then it swings too far this way. So they're often followed by a period where the terms get really negative. And this is what you're talking about. My view on this is you can't build a company without a founder or a founding team. And so if you make the economic relationship between the investors and the founders or the founding team so disadvantaged for those founders, like you're not gonna end up winning, right? So the kinds of things in particular that I think VCs should avoid and founders should avoid agreeing to are things like cascading liquidation preferences, multiples of your money back guaranteed before the founders see any money, or really like bad governance provisions, things that don't give the founder, a voice and a say in the governance of the company. Like those things should never be in a term sheet. If the proposal is, I got to invest at a lower price than your last round because the market has recalibrated, well, that's just, in my mind, that's just what is happening, and we have to all accept that. It's happening to us too. We have plenty of portfolio companies that raise money, call it 100 million, that are now raising at 50 million, and I guess we're taking it on the chin too. That's life. But so that I think founders need to be prepared to accept. But anything that your lawyer would say is not standard, you wouldn't typically see this, like I think you need to push back on those things, and particular things that seem particularly punitive to the founders. I think you should resist that, because I think what it means is it means that the investor isn't actually interested in sort of a sharing of success relationship. They're more trying to extract value out of the equation, and that's not a good partner to have. You have more to add on this?
I mean, it's the same. You have to meet and agree that the price change should happen. But when you have that same investor saying, "Hey, we're gonna price this at 50 instead of 100, and oh, by the way, the extra $4 million we're gonna put in, we have a 3 times liquidation preference," that's just bullshit. You got to stay away from that, because that is definitely setting up a poor relationship with the founders and the investors.
What I am seeing a lot now is investors, and we've done this, coming into a company that's had prior rounds of funding, making a proposal to invest at a much lower price than the last round, and throwing some additional equity on the table for the management team and the founders, and that equity has to go into the pre-money valuation. Now, the existing investors will scream bloody murder when they see that, because they're like, you're making this even worse for us. But the reality is, new money coming in is going to need to make sure that the founders have enough skin in the game to build a company. And so, that's really what should happen. I'm not saying that the founders should be made whole or anything like that. Everyone's got to take some of the pain together. But if the founding team owns too little of it, it's just not going to work. Lauren, how much more time do we have? 5 minutes ago, so we got some time for a few more.
Hello. I actually have a question for you, Katie.
Yay.
Oh,
You've been covering M&As and IPOs for a really long time, and I'm curious to hear your point of view of, you're up for moderating a great panel. What are some of the big trends that you're keeping an eye on when it comes to the venture capital space? And then now being in this as long as you have, what advice would you have for founders around crafting and telling their story in a more public forum?
First of all, thank you for emphasizing how old I am. But, I mean, gosh, so I broke the news recently. The Instacart IPO was coming and finally happening, and people didn't believe it, and it actually did happen. I mean, there were, as Fred mentioned, there were 3 tech IPOs recently. They didn't do great. So it's hard to say that, at least in terms of IPOs, that the window is super open right now, although we do know a lot of companies are, preparing to go public. They're just figuring out the optimal time. Last I checked, there were like 1,200 unicorns, 1,300 unicorns. I mean, some of those are going to be unicorpses, but there are companies that have when the time comes, they're ready to go. In terms of M&A, I mean, it's been obviously a pretty complicated regulatory environment. I broke the Adobe Figma deal last year and it still hasn't closed over a year later. So that does make it more complicated for companies to even consider making a big acquisition. And also there's just been a lot of confusion over how to value these things and what they should sell for, and whether companies are really willing to sell for such a lower price than where they were once worth, what they were once worth. So I mean, there's a lot going on there, but I'm hoping it gets busier. I mean, because last year was a little slow. This year too.
Katie, can I add something to that? You mentioned the word narrative, and that's such an important word. I think founders really need to understand. A founder of a company that I work with pretty closely sent me a recruiting video that they made, and I looked at it on my phone today, and it was really very much focused on the big vision, and it was great. And I texted him back and I said, it's really great, and I think that's going to help you both recruit and raise. So, and the earlier stage your company is, the more I think narrative is really important. But I think you need narrative all the way through an IPO, and you read great IPO prospectuses, they really do communicate the vision of the company. The thing that happens though is that over time, the fundamentals have to be there with the narrative. And so it's possible that you can walk in to a seeded, institutional pre-seed investor's office with just a story and get a check. Then you walk into Mark's office, he's going to want to see a little bit more. You walk into this firm, we're going to want to see a little more. And by the time you're going public, you're going to need to have revenues, you're going to need to have a path to profitability and all that kind of stuff. But narrative is always important, and I don't think that people spend enough time on that and really nailing the narrative, because that will help you recruit, it'll help you raise, and it's really important.
To add to that, I think that people lost sight of being efficient with your capital. There was we'll blame it on the VC world and capital in general and zero interest rates and whatever else you want to blame it on, but there was just a grow at all cost mentality, as we know, without focusing on the actual potential gross margin or potential earnings from those companies as they grew. And that capital efficiency makes a huge difference in the return and ownership. And at the end of the day, you as a founder are the biggest owner of the company, at least at the beginning, right? And I think that if you think about some of the most successful companies as a VC return, they raised very little capital. I can think of the Trade Desk raised $135 million. Zoom raised $142 million. Atlassian raised $160 million. These are not big numbers. Viva raised $7 million and is now a $20 billion company. The difference is they were very efficient with their capital and protected the company and their ownership as long as they could, as opposed to growing at all costs. In fairness, Trade Desk and Zoom, had they been almost 4 years later, had they started as a company 4 years later, they would have gotten way more capital, right? They would have just been flooded with capital and may have misspent it. But the timing was good to be efficient with your capital. And that goes with every stage. So if we have a chance to sit down with you and we're talking about your company, it's really like, the general, I'm going to raise a $4 million seed. Well, how are you going to spend it? Well, I'm going to hire 7 engineers and 2 AEs and 1 SDR, and you kind of give this, thing that you learned on Google. And I really want to talk about each one of those people that you want to hire and how they're going to impact the cost structure of the company and how you're going to get to that next round. Because I think we're going to get back to, when you go to see Fred, yes, he wants to see traction, but yes, he wants to see how you're protecting your capital. Am I right?
Yes.
Thanks.
One more question?
Hey, I'm Sushant, founder of Access.ai. We are a B2B SaaS company which takes video, AI, and human touch and transforms brands' website for increasing engagement and conversion. My question is about when most of the founders go through a journey and they go through pivots, and how do you look at pivots when should founders be defensive about it, or is it positive, or what do you think about it?
From our perspective, pivots are so commonplace. I mean, many companies, I think even Twilio never, they pivoted 3 times before they. There's a lot of stories we could tell of companies that have pivoted to become what they became. It's really how you go about it. Are you honest with the process? Like, this angle we've taken to sell our solution to these customer base, we don't think is working. But what I think will work is we focus over here. And if you give me a chance to try and I'm, keep you informed and here's our plan, of course we're going to support that. If it's just like, we're just pivoting, I'm going to try anything that works, that's not how you, sell the story.
No, I generally agree with Mark. I mean, pivots are just, part of our business. I will say, though, that the best investments I've made didn't pivot. Twitter came out of a pivot, but by the time we invested, it was already Twitter. But the best investments that I've worked with, from the minute that we wrote our check, they were doing what they were doing when we invested. And so, but there are plenty of stories out there. Slack came out of a pivot. Twitter itself came out of a pivot. So I think it is part of the business, and venture capitalists are open to it, and I don't think you need to be embarrassed that you've pivoted. But figure out what you're going to do pretty quickly and do it, because I don't think 3 pivots is a good idea.
And you should never be embarrassed for being a founder. It's really hard, and we know that up here. And so I think on that note,
yeah, I think we wrap.
Thank you very much.